Alright, ICT traders, welcome back here. I want to show you a very simple ICT buy model for beginners. And this particular buy model can be used by both swing traders and intraday traders. It is a very beautiful and simple setup. You can see right here on my screen. I'm going to show you how to go about it and what really you should be looking for, the time frame you should be operating from. Alright, so let me go into it. So starting from the time frame concept now, what time frame is best for this and how to use it? Now, to answer that particular question, the question of time frame, we wouldn't be having any challenge with a specific time frame because we would be navigating different time frames starting from the higher time frame to the lower time frame to get that type of model. And then secondly, we're going to talk about liquidity or point of interest. Liquidity is important. Where is the liquidity resting? Because I can tell you this, that interest rates move the market, but liquidity is like the fuel that moves the market. All right, it is the fuel in the vehicle that is moving the market, while interest rate is the reason why price keeps moving. But liquidity is the reason why we see price picks a direction and it goes into that direction. I hope you understood that. Then thirdly, we're going to talk about the institutional footprint. All right. What we call institutional reference point. I can just call it institutional reference point. Ref point. Just to put it right there. So these three very important things that we need to cover is important for us. So let's start from that, and I will come back here to show you how this buy model came in. So let's start from the higher time frame. Definitely, if you are trading in the forex market, daily time frame, 4-hour time frame is enough for you as a big time frame, especially a retail trader. If you are trading, institutionally, you can talk about the monthly, the weekly, and you can talk about the yearly. So going back to the daily time frame, if I am coming right here to the daily time frame, now two things are very, very important for us. Before we go back to those buy model, let me just close all the drawing. Okay, so this is it. Remember, I told you that the first thing you should consider is time frame. Secondly is liquidity. Thirdly, institutional reference point. Now look at this price action. Price has been moving to this area. The data also matter. Am I going to look at this data, this number of data from here to that area? Definitely no. What I need is to just focus on what I am able to see, the most recent price action, and that is why you don't want to do anything with the monthly time frame, the weekly, because that's too much of a data for you to consider. And if that is the case, then we can confidently focus on this area. Can you see this place? This area. So in this particular area, what then can our eyes see? That is the question. Now you come to structure. Here is a break of structure to the upside, which you can literally see. I don't want to delete this thing, because I will need it definitely in the future while we do this. So let me find a way of getting this perfectly. I've gotten it correctly. So look at this. Let's talk about this right here. Break of structure in the upward direction. Price moved up into this rejection block here before it crashed. This is even going farther than you think. I'm just showing you what has happened before crashing. Now, what do you think price want to do? Because this is a break of structure. The shifting structure started from here to the upside. That was where the bullish movement started. Move up here, retraced, move up to this area, coming back into this now. What you look out for is to look for that shifting structure. This place. shifting structure to the downside, shifting structure to the downside. And price had this shifting structure in such a perfect way, price coming back into this fair value gap and bearish mitigation block, which is this candlestick, price crashing. Now, what next did you see price did? Move down to this area. That was the draw on liquidity. We have draw on liquidity. So what is the bias of this particular movement? Currently, from the daily time frame, you can say that the bias is bearish. Shifting structure, retracing to this area, crashing. Now, after creating that, ultimately remember that price is trying to target this draw on liquidity. That is why I started by telling you that liquidity is important. And then further crashing into this area. This area is very important. I just want you to know where price is going to. But from the daily time frame, what we have is so much data for us to patiently wait for, and that is why we want to do business with the lower time frame. Now, after this break of structure, what did you see? That is basically external range liquidity sweep. Price has to come back to retrace into internal range liquidity, which is this bullish order block. At least what you need is 50% of this bullish order block for price to trade within the 50% of that bullish order block. It is called the mean threshold. And this is where the buy model came in. We are overall bearish on the daily time frame. After touching this bearish order block, we are now retracing into internal range liquidity, but this is an old high, which is the draw on liquidity, and ultimately price was targeting this area. But this buy on the daily time frame is just an attempt to cover this liquidity void. So if we go to the 4-hour time frame, what are we going to see? Remember, I told you that we're going to navigate different time frame at the same time. So this is it. Look carefully and see what I told you. On the 4-hour time frame, we first of all traded down here. Before this small movement started, the buy model, before it started, we traded into this area, leaving what? We left some point very untraded. So look at this. A bearish breaker, a breaker block. Yes, that is a breaker block, guys, because you see price did this, retraced, and then took liquidity crashing. If price is coming back, we expect it to crash downward. But when I saw that buy model, price did not start retracing. I only knew that price was going to retrace because I saw this area. I saw those area and I was happy to trade it. This was what I knew price did. Leaving this place. If I want to come back here, it means I will go bullish. And that was the only reason I saw the buy model in the lower time frame. It did what? The 15-minute time frame came in very handy. It came in very handy. If you would establish this to be a perfect scenario for the buy, you will need all your drawings activated. This is it. So this is the only reason why I activated that buy model. What did you see? It started from an intention to go back to a point of interest or institutional reference point in the higher time frame. Now this retracement can even come up to this fair value gap, but we are not sure where it will stop, and that is why we want to watch out and see how long it will take for that to happen. It's something simple. Trust me, guys, this is something very easy to do. Just know where price have traded, and in fact on the 4-hour time frame, without even sweeping the liquidity, you've seen price traded into this what? This is a bullish order block, and a fair value gap, not even minding what is happening on the higher time frame, you already have evidence that price will start reversing. So price, is this a mitigation block? Yes, mitigation block here and order block here. So price traded into it in the 15-minute time frame. That is where the wonder happens. Let me show you something that is very, very tricky. Very, very tricky. Let me take out these drawings since we are now in the 15 minutes. I just want to show you something that is very, very tricky. This is it, guys. This is it. This is what I wanted you to see. Price came, had this move. This is not a retracement. All right. This is not a retracement. But then price had this coming back. Now in the coming back aspect, we finally had a retracement here around this area, a shifting structure, price coming back into the fair value gap, it becomes a buy here. Is that not a buy setup? Stop loss here. And where are you going to target? You can start from the most recent draw on liquidity and you can take it up and up and up. This is a nice setup, but do you know that this trade did not end, did not work out correctly? And it's fine. If you have taken this one, this was a nice setup actually, because it is in that order block that we saw in the 4-hour time frame. Price crushed it. It didn't work. It didn't work. It just moved from here to this area and it crashed downward. So the next attempt now will come in still in that same area. I have had this kind of trades. Take the first attempt, get crushed, and take the second opportunity again. So look at this. You now see a new setup coming in. A new setup. That first one did not work. I let it go. It didn't work. The next one was this. Price shifting structure, leaving a breaker block right here, which is the setup I wanted to show you. Let me play it out so you can see what happened there. Okay, so this is it. This one did not work. This buy model did not work. For whatever reason, we don't know. Probably towards the end of the New York session, maybe the financial sessions for that day is about closing and the new day is starting. That was probably the reason why it didn't work. Absolutely, I didn't take the trade, but then if you thought that was a nice setup, it didn't work. Now another opportunity. Are you going to leave it? No. You're going to take advantage of it. If this didn't work, here is another opportunity coming in. Shifting structure, breaker block. You know what a breaker block is, guys? This is it. Price coming into the breaker, you go up with it. You know where the breaker is? This place. You see this W? This is a bullish breaker because price move up from there. So a breaker will give you this, will sweep liquidity by the left hand side and shift structure by the top side and shift structure above. And when it is coming back, this is the point for entry. And that was exactly what happened here. We saw this shifting structure moving up. This is a breaker, this guy. You see it? Boom. Price came back. But notice what price did. Price did not touch the breaker. And this fair value gap, can you see a fair value gap there? Let me show you the fair value gap. I think that will help a lot. This fair value gap, you see this candlestick? If you take it up to that point, this place and this place. Because this fair value gap is very big, what we do is that we want to take trade at the middle of it. Exactly the 50% of the entire fair value gap, and then it has the confluence with the breaker block. So if price did not come here and we saw it going up, it is possible that it is an inducement. Inducement is simply a deception that happens from price creating a fake kind of a movement inducing people into, let's take it, and boom, they are stopped out. So this was the exact trade I took, the buy model. It is that simple. You can always find it easy. Look for a higher time frame point of interest. As price reaches the point of interest, look for a shifting structure, return to an institutional reference point, take the trade. It is summarized like that. Look for a higher time frame point of interest, allow the higher time frame to trade into that area, wait for a shifting market structure in the 15-minute time frame, or highest the 5-minute, or the lowest you could go to the 5-minute time frame, not the 1 minute, the 5-minute. All right, look for a shifting market structure inside that point of interest, like this one. You see this area is the order block on 4 hour, so look for a shifting market structure inside it, price coming back, and this is your entry. It is as simple as that. It is as simple and straightforward as what I've shown you. I hope you're understanding this. So that was what happened for that buy model to happen. And then you can actually see that the buy model continued. You see it playing out to that area. That is the buy model, guys. The buy model starts the movement. Where is it going to? If you go to the daily time frame, you would see where it is going to. Let me adjust it and show you properly what you should be expecting. Right here, the daily time frame. You see, just the 50% of that, and we expect it to continue crashing. It is that simple. Look for where the higher time frame is going. If the higher time frame is actually trying to go to this area, as soon as the higher time frame reaches the area, which is this place, this is even a sell model, is the exact opposite of the buy model. As soon as it comes here, go to the 15-minute time frame, look for a shifting structure, return to institutional reference point, take the sell again to the nearest area of liquidity. I hope this helps. So thank you guys for watching. See you in another video.